there's this little known secret that very few people actually implement.
Yeah.
You guys have tapped into it in the provisions inside of this wonderful world of life insurance.
That's right. You're exactly right. And it's I feel like it's revolutionary. It's something that's not taught in your daughter's college, right?
Correct.
This is a way where they can get out of debt, sometimes a third of the time, sometimes saving hundreds of thousands of dollars of interest by just applying these concepts.
Welcome back to another episode of the Life Insurance Academy podcast. We have got one of the most impactful, one of the most important podcasts that I've ever done on this channel. I want to let that sink in for just a minute. There's a crisis in America. It's a silent epidemic, and it's a financial crisis, and it's one that most of us don't know how to, we don't know how to deal with it. We don't know what the solution is. We don't know how to solve it. And most of us we have symptoms of it, if we're honest with ourselves. And I'm excited today because we have coming to you all the way from Tampa, Florida, someone who has a solution to help people not only see the silent epidemic for what it is, this financial crisis, but they've built and provided a solution for it to put it easily into the hands of life insurance agents. They can present this to their family members, their friends, their consumers, their potential clients. This is not the selling of a product. This is providing a solution to one of the biggest problems we have in America. So I'm excited today. How's that for an intro, by the way?
Yeah, right? Wow, I better live up to that.
And they don't even know who you are yet,
No.
so they're excited. Like, who is this on the other
Thanks,
side?
Roger.
Have they brought in a congressman? What's happening? Is it the president on the podcast with Roger today? Today, coming from Tampa, Florida, Mr. John Phillips with Agency Rocket. Welcome to the podcast, man.
Thank you very much, Roger. I'm so excited to be here.
Good
Thank
to
you.
have you. So, John.
Yes, sir.
You've been a licensed life insurance agent, and you sell $10,000 a month in life premium. And no, that's
False.
That's not you.
No, that's not me.
That's not
you. I'm not your typical podcast guy.
No,
that's not me.
So we're here today to talk about a solution that you guys have developed for one of the biggest problems in America.
Yeah.
Let's talk about that.
Okay.
And then how this applies to life insurance agents. And if you're listening today on audio, I encourage you to jump over to YouTube and check out our YouTube channel at Life Insurance Academy, because we're actually going to be showing some screenshots of what we're talking through today. You don't have to. You can listen through, of course, if you're driving or if you're doing your regular morning routine and you're listening like you normally do. But I would encourage you, there will probably be some additional content over there. But John, man, you and your partner, Sean Meenan, with Agency Rocket are doing something that's revolutionizing the industry and providing a solution that most people don't even know are aware. So before we get into the solution, man, let's talk about the problem.
Okay.
And let's talk about how this applies to agents. Why are you in this space? What space are you in? And what problem are you trying to address?
Okay, so we create solutions for agents, right, to market things that are hard to market, right? So let me give you an example. So you can use whole life insurance to get folks out of debt, right? That is a hard conversation sometimes, though. There's a lot of moving parts. There's a lot of explanation that's hard to explain. And I think the average agent looks at that and says, no, I'll just go to something a little easier. So what we've done is we've provided a way to tell the story. And like you were telling folks to go on the video, right? We feel like we provide the pictures for the story. Mm-hmm. We provide moving images to help people understand how this solution works. Because I think there's a big problem like you were talking about.
What's the problem?
There's two. Okay, so one on the consumer side is we are in a buttload of debt. We're at
Who's we?
Us. America.
Us, America.
We're, 17 trillion, I think we're talking about, is the consumer debt that's out there. Okay, and that's a problem.
And that's a stat we just brought up.
We just
U.S.
pulled
consumer debt piles up to over 17 trillion total household debt balance in the United States by category, and it has it all broken down: auto loan, mortgage, home equity line of credit, credit cards, student loans, ancillary loans, other.
And you think there's a lot of folks that make money off of that, right? I think there's a lot of people that want you to stay in debt. And I believe the financial system is set up to be like that, that they make money off the debt, you stay in debt. And I think if you want to have a different outcome than most folks, you have to do something different.
John, my daughter just started at the University of Cincinnati as a freshman, my youngest daughter. And it's interesting because in the orientation week when we went up there, it's interesting. The facilitators doing the orientation week. Yeah. One of the segments was now you can get them set up on this type of credit card because that can help them with it. And I'm thinking,
start them early, right?
Let's start them on debt like right away. Are you freaking kidding me?
That's right.
I'm like, can you not talk to my daughter about getting into more debt because most of the students in here are going to go into debt, go to school, and now you're talking about adding more debt. I hope you have just as many solutions how to get out of debt because, I don't appreciate that. I mean,
and I don't think
programmed, man, in our society. It's like
go into debt.
It's like we've all drank the Kool-Aid.
Yeah, right. So there's the one solution is that we are providing a way for folks to get out of debt. It is not what is taught. It's a kind of an alternative solution, but it's fantastic and it's wonderful. And we'll go into that probably later on.
What are the traditional ways that people have to try to get out of debt?
Well,
what are things that you see people trying to do?
Well, there's folks on the radio. There's other folks that are telling you how to get out of debt, maybe shrink your lifestyle back, right? Beans and rice, right? Cash envelope plans. Basically, shrink that lifestyle down as far as you can possibly handle it for, 6-7 years and make these payments and stack them up, whatever you can do, and then get out of debt and you're finally debt-free. But what happens, though, is a lot of folks during that time, they have children. They have kids growing up. They're missing out on baseball games. They're missing out on life, right? And so that is a solution. It's just a hard one. And most folks that get on it will do it for a little while, and it just kind of drags. They just I don't like this lifestyle, and they leave it.
They don't stick with the plan.
Yeah, it's just not sustainable. Over the long haul.
Do you think people even really understand the negative impact that consumer debt has on their life, their cash flow, the drag that it has on their financial future?
That's a good point. Yeah, I don't think they do. I don't think they do. Some do, but it certainly is a negative drag on your life. Like most folks, they have their payments for all their different things that they have, and then they have this debt payment. And as they keep adding debt, that debt payment gets larger and larger. And they look backwards and they're wondering, what did I spend this on? It was 5 years ago, and I'm still paying on it. It becomes this big shackle that just weighs them down.
I see people who buy things, consumer debt, like they'll put maybe Christmas presents, right, on a credit card, and then they've got a small auto loan because they buy another car for their daughter or their son, and now they've got another small debt, and then they've got some other consolidated consumer debt on. They've got like a Banana Republic card, and they've got like $700 on that because of the time they did that, and then they've got another one over at Lululemon because everybody, you got to have your Lululemon, right? I mean, who's not wearing Lululemon right now? Yeah. And there's all these consumer debts that we get into, and then they go and refinance their home.
Well, okay.
And then because they got a low interest rate, and then they'll say, now you take that high debt and roll it into that, and then really what happens when you think about it, now they're paying on the Lululemon underwear for 30 years. Can you believe that? Most people don't think about it like that. That's true. Right? They don't think about their debt like that. We are in a mess, man.
They have a weird relationship with debt, right? It's just an odd thing that we just keep adding to it, and it hurts us, and we don't care. We keep adding to it.
We got fired up a little bit as we were preparing for this podcast, and I likened this silent pandemic or silent epidemic to the pandemic, the health pandemic that we just came through in the last 2 or 3 years here with COVID. And when that health pandemic hit, people were looking for immediate solutions. They got afraid. Yeah. They were scared. Everyone went to their homes. It's like take for cover, go underground. Everyone put on a mask. Yeah. You need 2 masks. Let's get 1 vaccine. Let's get 2. Let's get a booster. Oh, that's still not working. Let's get another booster. Right. The need to do something was evident, even though if we didn't know if anything was going to work. People just felt like they need to do something. And so if you're not doing anything, then you must hate society. Right. Because at least we're trying and you're not. So everybody's scrambling around. With this silent epidemic, man, it's like sneaking up on us and it's lulling America to sleep. And now we've got agents that are in this business trying to figure out how to get ahead in life. Yeah. And they've got consumer debt.
That's right.
I want to pause for a minute. If you're an agent listening to this podcast or watching this episode today, Do you have symptoms of this silent epidemic? Do you have consumer debt?
Yeah. Raise your hand at home. Right?
Do you have consumer debt? If you do, you're spending more than you're making.
Mm-hmm.
If that trend continues, the financial institutions who are gaining interest off you are going to win. The casino always wins.
That's right.
They always win. So this is a clear, giant thing. And so as I got to know you guys, you and your partner, Sean, the more passionate I got about solutions, because I'm all about impacting people.
Right.
I'm all about making sure that people have a path forward to an abundant life. And that means a life free of debt, free of the chains or the shackles that credit debt and student debt, it's just stupid debt, right? It's stupid.
Yeah.
It's stupid debt that it has on us, and it really puts people not in literal chains, right? But it puts them in figurative chains, and they don't know how to move beyond it. And you guys have come along, and there's this little known secret that very few people actually implement.
Yeah.
You guys have tapped into it in the provisions inside of this wonderful world of life insurance.
That's right.
You guys have tapped into some provisions inside of there where you can empower agents to be able to use those provisions and your software solution to present realistic, plausible, step-by-step process where they can actually see a path forward, and you can actually show them like the light of day and the light at the end of the tunnel and a clear way to get there. Would I be framing that up correctly?
No, you're exactly right. And it's I feel like it's revolutionary. It's something that's not taught in your daughter's college, right?
Correct.
This is a way where they can get out of debt, sometimes a third of the time, sometimes saving hundreds of thousands of dollars of interest by just applying these concepts. Now, the flip side of it, and you were talking about this too, as they get out of debt, now they have also a big pile of cash in their life insurance.
Who wants
policy.
a big pile of cash?
Okay, piles of cash are good, that they can then use in the future to borrow against. And so we teach them how to use this as a bank in the future. As you grow the cash value, you can use it as a bank. You take out a loan, it still continues to grow, et cetera. You know the drill. And we'll go into that in a minute. But we're transforming how their relationship with debt, their relationship with money, with growth, with banks, right? Imagine in the future you have this money that you borrow against to do all of your banking, where you don't have to apply for loans. You just say, I want it. There's no credit checks. You can opt out of that entire system. And that's what we're teaching folks how to do with our solution.
So what are these provisions inside of a life insurance product that agents maybe they're not familiar with, that they can learn about, that makes this solution so powerful? Because those provisions are there whether agency rocket's there or not.
That's right.
Right?
That's right.
The solution lies inside of the financial products that we have access to with our life insurance license.
That's exactly right.
The solution is there.
That's right.
Now, how simple we can make it for the consumer and the agent, that's where you guys come in.
That's where we come in. And so I believe our solution helps the client, obviously. We just talked about that. I think our solution helps the agent. And what I mean by that is a typical insurance agent will go and sell life insurance mainly on a death benefit or some type of, something like that. And that's great. But most folks, let's say there's a guy that's 35 years old, has 3 kids, kind of struggling to pay his debts, which is most folks. You come along as an insurance agent, you're trying to sell them life insurance because what if you die? We need to protect your spouse and your children. It's wonderful. It's a very noble thing to do, and they need it, right? But that guy's going to look at you and say, you're just a new bill for me. I have to pay whatever it is a month now.
Sometimes they do. Yeah, for sure.
Sometimes they do. Right.
Yeah.
Exactly. And a lot of times they're thinking, that conversation is very important. I need to address it, but I'm going to have to put it off because I'm just not ready.
That's because they're already in debt.
Because they're in debt.
And they've got more money going out than they have coming in. To think of adding another $80, $100, $150 a month for a life insurance premium, it's just not in their purview. They can't do it.
That's right. So what we're doing is we're flipping the script a little bit. So now you can approach this client. Instead of talking about that, you talk about, I can help you get out of debt. Really? That's weird. Well, let me show you how it works. And a lot of times you'll find that he can not just afford the $80 a month, but there's hundreds of dollars a month that we can find to put into his debt elimination tool and he gets out of debt so much faster. It's a different conversation because your net that you're casting for clients, for prospects, is so much wider. Who's in debt? Almost everybody. And everybody that is in debt can talk to you, and you have a solution for them.
There's new people that are on the podcast.
Okay.
They have no clue how this works inside of a life insurance policy because they think life insurance is for when you die. It pays a benefit to your family.
Yeah.
You mean it can be used for other things, John?
It can.
What are these provisions? What are these provisions we're talking about in whole life that you guys tap into that most people don't know about?
Let me give you the basics of the strategy, and then we can kind of maybe go into the software and talk about it, right? So the basics are we're going to try to find any money that you're paying above and beyond the minimum payments for your debts. Okay, we call that inefficient overpayments. Okay, you might have a Visa where the minimum payment is $100 and you're maybe paying $200. Okay, most of us try to do a little bit extra. We'll grab that $100. Our software identifies that, by the way. We'll show it in a minute. But you go through every single debt, everything that they're doing, their investments, their savings accounts, what they're doing in their financial life. And we try to identify any money that is above and beyond the bare minimum that you can pay. We take that money, we put it into a whole life policy.
Why?
Because it's going to be our monthly premium, okay? It's going to build cash value.
What is that?
Within the policy. So
I'm breaking this down to simple.
So within a whole life policy, we have basically an insurance component.
Yep.
And we have a cash value component. Works almost like a savings account.
Yes.
With certain umbrellas over it, with the taxation, nice things that are set up for life insurance that we can take advantage of. Okay. So we want to build that cash value up very, very high.
I've heard cash value is not good. I've heard people on the radio say, never do that. That's a ripoff.
Well, I would have to disagree.
Okay.
And I don't know.
So make your point.
How much more to say?
Tell me why.
Right. Okay. Well, we build up our cash value. Right. What happens is as the cash value grows, the really neat thing about this strategy is that the insurance company allows you to borrow money against that cash value. Okay. And so what we do is we pay our minimums on our debts.
So I'm creating another debt by borrowing money.
Well, yes.
Okay.
You're transferring debt.
Okay.
And again, I'll show you in the software. It makes a lot more sense. So you're going to have this cash value. You're going to pay your minimums on all your debts. As soon as your cash value gets to a certain level, let's say you have a Visa as the card we want to knock out first. We get to the Visa. The Visa's got $5,000 of balance on it. Your cash value gets to be around $5,000. We would tell you to do a policy loan. So we're gonna borrow money using the cash value as collateral.
So we're not cashing it out. We're borrowing money.
We're not cashing it out. And the reason why we don't is we feel like the cash value is a money tree. Do not chop down the money tree in order to do these things, right? Keep the money tree growing because the greatest thing about the strategy is the cash value grows even though you're borrowing against it. So think about it. If you've got a 5%.
That's a hard concept, by the way, to get your head around. If you're listening to this new for the first time, he just said, don't cut down the money tree. The cash value in your policy continues to grow at full value, even though you're borrowing against it. Like, think about that for just a second. Now, you probably have questions. Throw those in the comments below. Keep listening. We're going to answer those questions as we go. So I know that you have some questions right there. Hang with us. We're going to get to some of those answers.
If it's set up correctly, right?
Yes.
That's the little disclaimer for all this. So you have to set these things up the proper way. So, right, the cash value grows. You're able to borrow against it. And think about it. What if you're, I'm just going to pull out numbers. If your cash value is growing at a guaranteed 5%, and you can borrow against it.
That's more than 401k.
It is. We just talked about that as well, right?
Yeah.
Right?
Yeah.
People poo-poo at that 5%. So let's say it's growing at 5% guaranteed every single year. And you can borrow against it, and they're going to charge you 5% interest rate. Think about what's going on there. We're canceling out interest. We're earning and interest, and so one of the things
we're
that we
earning
talk
interest
about,
and canceling it all at the same time.
at the same time.
So I'm going to ask you a question. I'm going to try to put this again in context for a new person or brand new agents that are just selling maybe final expense or mortgage protection term. They really haven't gotten their head around these provisions inside of a whole life product to understand how this can really work. And most of them are kind of like they know about it. They've heard about MEC limits. They've heard about, maximum cash, minimum death benefit in the funding strategy. And they hear some of these other agents talk about this, and they sit in the room and they don't want to show ignorance, so they don't really ask too many questions, and they go home and wonder how it works, and then they just keep doing the same thing they've always done, and they don't really get into the power of this solution, right? And so
I think you're exactly right, Roger.
I'm going to ask a question.
Okay.
Would the cash value inside a life insurance policy, would it be like equity in your home?
Yeah.
So it's like equity in
That's
your
right.
home. So you could have a
Without the
mortgage. You could have a mortgage for $400,000,
Yeah.
right? A $400,000 mortgage. You have the house is valued since you purchased it. It's now valued at $600,000.
Yeah.
So you have $200,000 in equity.
Correct.
You can borrow from your own equity line
That's right.
$100,000 if you wanted to, right?
Mm-hmm.
And you don't have to pay tax on that 100 because it's a loan.
Because it's borrowed money, right?
And if the housing market goes up next year, it's not going up from the 600 minus 100 and now it's 500. It's not increasing from 500. It's actually increasing
Market
from the
growth.
full
Right.
600.
Yes, that's
And
right.
you're telling me that the cash
there you
value
go.
inside of a life insurance policy acts in the same way.
Yes, and another way to look at it is, so we know, how do banks make money, right? So you have a lot of money.
Fleecing us all.
You're,
Fleecing us all. That's how they make money.
You're going to put a lot of money into a bank, right?
No offense to people that I do banking with. So if you're listening to this podcast, I love you.
So you're going to put a lot of money in the bank, Roger, because you're a very wealthy guy, right? And the bank, unless you put it into something neat, but the bank is going to pay you a pretty low interest rate.
Neat.
Like a CD or just a guaranteed, like a
Yeah.
savings account. They're not going to give you a lot, couple points, right?
0 point
They're
nothing.
going to take all that money you put in the bank account. They're going to come to somebody like me that's poor, right? And they're going to say, John, you need money, right? How about we let you borrow a lot of this money that we have here? It's Roger's, but we're keeping it. But we're going to charge you 20%. All right? So they're giving you 2. They're paying me. I mean, they're paying you 2. They're collecting from me 20. So they're making 18
off my money
off your money.
that I've given to them
That's right.
because I've been duped into thinking that I need to
That's
put my
right.
money into a bank.
Now, don't take me down that rabbit hole. But you're right.
There's a rabbit hole?
Yeah, well, we'll go. You tried to take me down there with the COVID and the vaccines, but okay. So, but we're not going there. All right. So the bank makes the 18 points. All we're trying to do is show you that you can run your finances the same way, and this is how the cash value can grow. Let's say so in the beginning they're about the same. I told you the Visa $5,000 balance, $5,000 of cash value, right? The cash value will start to grow to the tens, to the 20s, to the hundreds of thousands of dollars, and your debt will start to lower and lower and lower. So now you're going to be earning a lot more interest on that money and paying a lot less interest, like a bank does.
Yeah.
Same principle. So your finances can run the same way. I can't talk. Sorry. Your finances can run the same way as a bank.
And so you can borrow against your own money that you're
Correct.
funding into this cash value and use that to pay your debts first.
Correct.
And ultimately, once you get those things paid, you could really leverage it to pay for your life.
So that's the next stage of it, right? That's the part after your debts are clear. Now we can use this as your bank, right? So you can borrow against it for, like you just said, for anything, for college, for a reno in a home, an RV, a boat, anything that you need in the future. Instead of going to the bank and asking, can I borrow it? Do you think I'm okay? Is my credit score all right? What's my interest rate I'm going to get based on all kinds of factors? You know the interest rate already. You borrow against it. And again, you're not pulling money out. So let's say you need 50 grand. The 50 grand stays. You borrow 50 grand against it. The 50 grand stays there and continues to earn the 5% while you pay the 5% on the 50 you pulled out.
You have access to it.
That's right. So it's almost a zero interest loan if you think about it.
Yeah.
Right.
So you guys have created software, right?
have created
that speaks
software.
to all this. And so for those of you who are listening on audio, I think you can go to lifeinsuranceacademy.org. No, what is it? Where are we, Adam? Yes. lifeinsuranceacademy.org/agency rocket.
Correct.
They can go there
That's
and they
right.
can start seeing how this works. Why don't we, for those that are on YouTube, why don't we show them a little bit about what this looks like?
Yeah, again, you folks that are on audio only, please get on YouTube like Roger says. We've got a lot of fun things to show you. So I'm going to show you.
And there's 2 chassis to your product. So
There
when
it is. Let me
when
go
you
back
go to
here.
that website, guys, you're going to see that there's a debt action plan, which is a strategy that we're talking to John about today. And there's another component called My New Retirement, which is a tax-free retirement strategy using IUL, Cash Value Index Universal Life products. And we'll cover that in another episode
we love them
or
both.
at a later time.
We love them both.
Today, we're talking about eliminating debt and curing this silent epidemic that we're in.
That's right. And it's called the Debt Action Plan. Now, I'm going to show you just how you put together a scenario and how an agent might use this to show the client how this whole thing works. But we have other components in our system. We have landing pages where you can send your prospects.
Do you have some of those?
Yeah, sure.
Let's just do a quick high-level flyover of what this looks like and the components that are in it. Because I know that there's a landing page. I even got one. I got one, guys.
Yeah, right.
You can
well,
look,
let me go back to this website here and just show you real quick. We have 3 components.
Mm-hmm.
All right. Reach. We call Reach. That's our prospecting tool where you send folks to. They get educated. They register to watch webinars. As they register and as they interact with that site, they're added to Tracker, which is our CRM that's built into our system as well. Keeps track of everything, let you know where everything is. They're all color-coded, all kinds of fun things. And then when it's time to close the deal, we go to Analyzer. So that's our 3 components.
Or present, at least.
Exactly.
Yeah.
Present the deal.
Yeah.
So Reach, Tracker, and Analyzer are all 3 right here. So if I go to Reach and I click on Debt Action Plan, that's what we're talking about today, we have opt-in pages and we have appointment pages, right? An opt-in page is for folks that you don't know. They're for cold contacts, and here's what they look like.
Okay.
You can go here and view a 2-minute video. Now, all the 2-minute video says is most folks save money or spend money throughout their lifetime in these ways. They'll put a lot of money to interest, a lot of money to taxes, some to their housing, et cetera. It's usually about half of their money goes to taxes and interest throughout their entire life. Just think about that
Isn't
for a
that
second.
sickening? I think I threw up in my mouth there a little bit.
And then we have
might have been the tacos.
So the other
That's
half,
why you guys
Roger,
didn't have as much pico as I did.
Yeah,
I ate a little too much pico.
So on the other side, so halves for those, the other half is, we call that your lifestyle expenses.
Was it you that didn't order the onions?
I didn't order the onions. That was you. That was
Okay,
you. And
maybe it's the onions.
That's the onions talking right now.
But no, this is serious. I mean, when you think about 50% of all of our money going to interest.
So we actually, I don't, maybe this will.
Are you hearing this, guys? Are you guys like, for those of you listening, watching, like, I mean, this is why it's called the silent epidemic.
Yeah.
I didn't know that number.
Yeah. Isn't that something?
That is sickening.
So in our little video, I'll just show you this little piece of it. We talk about, there's where all the money's spent, right?
Oh.
And then most advisors will focus on that side.
The other half.
Right? And
What they have remaining after
that's what you'll
interest.
hear on the radio, right? And then we ask the question.
Those Sunday talk
We
shows.
even talk about cash envelope and beans and rice, right? And then this is a video form, but I'm just showing you kind of slides.
Yeah.
We ask the question, which side would you rather cut back on, the half on the left or the half on the right? Well, of course, that side. And that's all we're doing is presenting that there's another way to do this. Fill out a form here, give you your name and email, and we'll get you more information. And so they do that. And they put their name and email in there, and they watch about a 12-minute webinar, okay, that explains how this whole thing works.
So the agent is not actually presenting
That's right.
and nurturing the interest. Your system and software is doing all that for them.
That's right. We're really, and this is what Agency Rocket's all about. We're trying to teach the client how to buy instead of the agent how to sell. Okay, and it's a different way of thinking. So we're trying to educate that agent. When the client sits down with you, they already have a small grasp on what's going on. They need your expertise to push them over the finish line, but they already understand how the money works, that we're going to be taking from their taxes and interest expenses. We're going to be taking money off their debts to help fund the cash value life insurance. So they're pretty far along the path already before they even sit down with you, and that's the beauty of the system. All right, so we got their name. They flow into Tracker. I'm not going to show you Tracker. Tracker is a CRM. It's awesome, but it's nothing really new and earth-shattering.
For those of you who don't know what Tracker is, if you are using like a CRM like Radius Bob, maybe you're using Impact Link Plus, maybe you're using Agency Block, like there's multiple, if you're using like a Salesforce or a HubSpot, like there's multiple ways that you can track business. This one has a built-in software that and a tracker that goes with the platform.
That's right. And we also are able to integrate with a lot of those systems you just talked about.
Perfect.
So our systems is relatively simple as far as the CRM side of it. We do offload that data to other software
so the
packages.
leads could be imported into like an Impact Link Plus.
That's exactly
and
right.
And they can nurture and see
and they
this
can nurture
different
it and
stages.
do all the things that you have.
Beautiful.
Exactly. So
Awesome.
integration's the key there.
Awesome.
Now I'm going to show you how you would go. I've already filled a lot of this data out, but I'm going to show you how you work through this scenario with a client.
Okay.
So I'm sitting here with I'm a sample. And what we do is we work from left to right with these tabs.
For those of you that are listening, there's a process. So John is going to be kind of setting up a scenario. We're just going to have to talk through this probably high level.
Yep, no worries.
And you guys can get in and play with it on the and take a look at it online once you get a chance.
Yeah,
But yeah,
highly recommend coming and checking out the video version of this thing. So we have different tabs on the screen, guys, and we have a mortgage tab where you enter in all the mortgages for your client. Okay, in this case, we have one mortgage. Looks like $350,000, 8% rate, et cetera. They enter all this information in. What I like to do,
I like the fact that you've got an 8% rate because it's probably
actually
going up
there, right?
Probably
we
going
used to
up
put
again.
3s and 4s, and not so much anymore, right? Check this out: 90.61% is their effective interest rate. What is that? That means that $2,575 monthly payment, 90.61% of it right now in that part of the loan is going to interest, and only 10 is going to principal.
in that first payment.
And anything you enter into our system, we have a full amortization schedule. So watch, this is a 30-year note. Here's that principal payment. Here's that interest payment. Watch, I'll go all the way to 30 years. Let me go halfway. And there's a lot of numbers here, guys.
So we're looking at a large spreadsheet right now, and we're walking through how much of the principal is actually going to the debt and how much is going to the interest.
That's exactly right.
And it takes all that time for it to come down. So what is the net effective rate total? Because it's not 8%. You know the number.
Yeah, I mean, it's for this exact loan.
Yeah.
It is.
What is the total real rate? The rate
61%.
61% that we're paying on a 30-year mortgage.
That's right.
If it's paid, to its term.
And it's not going to, right? I'm 15 years in right now, and it's 60-something%. Most folks are going to refinance. They're going to move.
And then they start it over again. And then they're paying 90% again.
And back up at 90.
60.
And so you remember that you remember that graphic about all the money we're paying in interest throughout our lifetime? That's where it comes from.
Maybe we can just keep sedating ourselves by the sour taste in the back of our mouth. We keep telling ourselves it is the PICO and it's not the financial crisis.
Agreed. All right, so on this screen, what we're asking our client, what's the minimum or what's the monthly payment for your mortgage? And are you making any additional payments towards principal? Most aren't.
Yeah,
most are not because they have
mortgage.
Consumer debt, right?
Yeah, because it's their biggest.
But you can if it was there, the system would grab that.
Yeah.
Now we go to the consumer debt tab. Now I've got 4 debts here. I'll go and enter one more in while we're talking, just to show you how this works.
So what you're doing is you're looking at all of their debts.
Looking at all of their debts.
So everything. It might be that table that they bought at the furniture store after college because it was easier to finance it, and the guy said it's 0% interest if you make all the payments. But as soon as they miss one, it goes to 21% interest.
Whatever, right?
Yeah, like all that stuff. And listen, I know you're listening, and some of you just got hit because I nailed what you guys did. Because guess what? I did that same thing when I graduated from the college. Like you're just trying to figure life out, right? You're trying to figure life out, and this is what you do because you're like, well, that sounds good.
Yeah.
And you've got no one teaching financial literacy, and so you keep getting yourselves into these consumer debts. So we're going to list all of the consumer debts.
All their debts we're going to see. So here's the
and
magic
all the
thing.
payments that you're making towards them.
Right. We want the minimum payment that's required right now. And then we actually, the next question is important. What's the actual payment on this one debt? What are you making? What's your average actual payment on this debt?
I want to ask you a question. Do most credit card payments that are the monthly payments that are asked for, is that the minimum or is that the requested? Like on a statement. You get a credit card statement from MasterCard.
Well, I guess it depends on some of them, right? But usually it's minimum payment that they want on there.
So it's not a payment above the minimum typically?
No, usually not on a credit card. You have your minimum payment that's due.
Okay.
Right? Mm-hmm. And folks will either can pay that or pay a little bit extra towards it to make some progress.
And on those types of things, they try to pay extra because they like it's only $1,200 and they're just trying to get rid of it.
Throw a little extra here and there. Some can't. Okay. Some are only minimums, but most are trying to make some progress. Maybe they'll pick the one that has the highest rate or whatever. So here they all are. Mm-hmm. Right, and what we've done with the software is we've identified like this one is paying the minimum.
When you say this one, what is that?
That's the Visa, the top one on the screen here.
Okay.
Yeah, right. Yeah, I forgot people can't see. So the Visa has a minimum payment of $194, and the actual payment that the consumer told us is $194. So they are making the only minimums, right? So is the next one, which is an Amex, but on this Discover, it looks like they're making a $300 overpayment. That's quite a bit.
Okay.
And on the installment loan, the auto.
So the Amex or that Discover card is the minimum is like $695 a month, but they're actually paying $995 because they're trying to get it knocked down.
They're doing $300 over. Yeah.
Okay.
And that's the highest interest rate.
Those are called revolving credits, by the way. Those are the ones that keep going up and down. Those are the ones that get us, man. Revolving credit, it's like a revolver. You might as well shoot your brains out.
It's real tempting to keep putting money on that thing, right?
It's terrible.
How much room do I have on it? Let's fill it up right now. And of course, on the chase, there's the minimum, and then there's the actual. So what's happened is the software has determined that there's $350 of overpayments
Okay.
on the consumer debts. And we grab that number, and it's up here at the top.
Okay.
It's added to the 1,000.
Sure.
Investments. Now, this is a place where most people don't understand that there's some money to put into the policy, okay? Savings account. That's an investment. How much are you putting into savings every month? Maybe $250. Okay, great. I've got a 401k on here. It's qualified money. There's $50,000 of account value there, and they're putting $200 into that. I'm going to suggest for these purposes that we don't pull the $50,000 out of that 401k. I don't want to deal with the taxation and fees and whatever else. I will suggest we do the $200 and redirect that into the policy.
So you're going to say stop contributing to your 401k
in this instance. So you can determine that as an agent. What's the best way to do it?
I'm going to get you and Dave Ramsey on one show together and let you duke it out.
Don't do that. It'd be fun.
I think you'd win.
So we have $450 of overpayments.
You look more fit.
Oh my gosh. A wrestling match maybe. So $450 of overpayments to these income sources. We're just collecting what they're making every month. Insurance policies. If they have any other insurance policies that are out there that they're putting money into, we might want to stop those because there's an insurance component to the solution, or we might not. You can determine that as an agent. But what we've done is we've determined that there's $1,000 of monthly redirecting money that we want to put into the policy.
So your client, as an agent, your client has all these bills.
Yeah.
They're making what they feel like are obligated payments each month. They're also trying to be good stewards. They're trying to save some money. They're trying to contribute at work through their 401k. And if we just pool all of that and direct it and attack the debt through your software, your software is going to show them the opportunities that exist with what they're already doing. So we're not asking these consumers to spend any more money.
That's the key. That's the key.
So you're not asking them to make an additional premium payment for life insurance.
You can leave your wallet in your pocket, Roger, right? You're exactly right.
So what is the magic question? If I can show you how to eliminate your debt without spending any more money, would you be interested in having a conversation?
That's it.
Is that the pitch?
That's the pitch.
Is that the prospect?
That is absolutely it. And so all we're doing, Roger, is redirecting money. They're already making the payments to somebody. We're redirecting it.
Can't you do this through envelopes?
Well, you could. No, you can't.
This shows you exactly. This shows you exactly where to put it, how to put it, and this is a visual for your clients.
That's
agents
right.
Literally can show this to their clients.
So watch this. We went and put together $1,000 a month.
Or listen to this if you're
listen
not watching.
To this audio, guys. Please watch the video. All right, so $1,000 a month. We put that into our policy. I've put together an illustration.
Yeah.
Okay. I'm going to upload that PDF illustration to our system. Okay. And this is the beauty of our system,
it's
right?
It's a paper PDF. Well, like I say paper.
It's an electronic PDF.
Yeah, it's an electronic PDF of an illustration.
Maybe it's 50, 60 pages long.
And your software analyzes all that.
It just pulls it up and it's done. How long did that take? 10 seconds maybe? And we have a whole bunch of stuff that showed up on the screen. Again, you audio guys, please watch the video, but I want you to see something, Roger.
They're going to get tired of hearing that.
I know, they're getting tired of it.
I don't want to watch it on YouTube.
But look what we did right away. We have 29 years and 9 months is when they are scheduled to get out of debt. Okay?
And what does the new strategy show them?
13 years and 6 months.
So they're cutting it to less than half.
Did you see that number there, though? Saved
no,
interest.
I can't see it. That's far away, and I don't have my glasses on.
So $218,000 of saved interest.
$218,000?
$218,000 of saved interest.
16 years.
Yep.
16 years and $208,000. Isn't
that incredible?
I think I want the money and the time.
Yeah, right.
Yeah?
All right. So I also want to show you over here the payoff order.
Okay.
I can select Snowball and Avalanche. What is that? Well, Snowball is where we order our debts from the lowest principal first to the highest, and Avalanche is from the highest interest rate to the lowest. Okay, we're going to select Snowball, and what it does all this math in the background and shows you what that does. We have a lot of other settings up here that I don't want to talk about right now, but it helps this thing really optimize itself. Okay.
So as we're talking this through, your software is taking everything that they've done. It's taking the illustration that you've run. So you're building a whole life illustration,
Correct.
a solution. Where do they learn how to build this properly?
Well, that'd probably be from their carrier. We want to redirect them to their agency, to their folks that their mentors and their agencies and their carriers to put this together properly. But they'll know how to do it.
So there's a couple of key pieces that these whole life policies need to have. What are those components that they're looking for when they're selecting that carrier and that product?
Okay, so first off, we like for you to use a participating whole life.
Participating whole life. What does that mean, John?
So that means you as an owner of a policy can participate in the profits of the company. You co-own the company basically in a way.
Okay.
And they pay you dividends. So you have a guaranteed rate that you get.
What's a dividend? Is that an interest?
Yeah.
I'm asking very rudimentary questions for you. Yeah.
This is a test.
Yeah.
So they'll pay you dividend, just like that you would get with stocks. With any kind of investment, you would get a dividend paid to you.
And typically it's a guaranteed fixed rate?
The dividend is not.
Okay.
So you get a guaranteed rate with the policy.
Okay.
You get in addition to that, you get a dividend that is actually not guaranteed.
Correct. So you're getting a fixed rate plus a dividend.
Plus a dividend.
If it pays dividends.
If it pays dividends, we like the ones that do.
Yes.
Because it's just more icing on the cake, right? Makes the numbers work well. And this one that we're looking at actually does.
Okay.
I can toggle with the software, include them or not, but
okay.
we're going to include them.
Is there any other features in that product that are preferred?
Yeah, so you need to have one it's called non-direct loan recognition.
I've heard it said indirect.
Indirect, excuse me.
Indirect, non-direct.
I say indirect loan recognition.
I don't know if there's multiple ways to say that.
And that's what we talked about earlier, where you can you have money in the policy, you can borrow against it,
okay,
and it continues to grow like you never borrowed against it.
That sounds like a fancy term, indirect recognition.
Yeah.
Why is that important?
Well, that's how the whole thing works. It's how the whole thing works. If you
what is that to the new agent that's listening? It's fine for us to tell them that's how it works, but what is that? What is indirect
that means
recognition?
that the money can continue to grow at that guaranteed rate, whether you have money borrowed against it or not.
And is there limitations then on those as to how soon you can borrow it? Are there some policies that have restrictions on that?
There can be. Typically, they're pretty fast.
Okay.
Within 30 days or so, that's typical. So you can get that money fairly quickly.
Okay.
But again, it's all these things that I'm saying are variable. Like it depends on the policy, it depends on how you structure it, depends on the carrier, on their product line, et cetera.
So you're building that illustration.
Build the illustration.
What are give me 5 top companies that you guys like to work with that are really good companies for this model. Maybe five consistent ones.
We like Foresters, like Lafayette, Mutual Trust. Those companies we like pretty well.
Okay.
One America.
Yeah.
Yeah. Emeritus as well.
Yeah. Okay. Perfect.
Okay, so a few of those.
For those agents that you may not have that contract or you have that contract, like that's a good place to start.
I would think.
Right? So start with one of those.
So what I want to show you next is now we've got everything in there. We can print out a really pretty report and show them how they can save all this money and how it works. But I like to go to this comparison tab, which I think is the best part. Where I can compare their current path, their current strategy with the new debt action plan. Okay, now on the screen, for all you guys that don't have the video version, all the debts are listed on the left side for their current plan, and all the debts are also listed on the right side with the debt action plan. And I have this slider at the top, which lets me drag month by month into the future. And as they make their payments, it shows the result of their payments below. So you can see that this, for example, in month 8, our balance has gone down on the Chase here, and it's gone down not quite as fast on the debt action plan on the Chase, all right? What's happening, though, is that you're allowing the agent to show the client what's happening with their bank and with their debts at the same time as they march through every month of this program.
If they keep moving forward the way they were doing it before.
That's right.
Or if they implement the new strategy on the right. They can look at both and see what's happening.
At the same time. And so it makes it really easy to explain what's happening. In month 8 here, for example, my cash value has grown to $27.59. My balance on my Chase is $27.44, so it's going to trigger our very first loan, right, that we talked about. We're going to borrow money against the cash value to pay off the Chase. We're going to do that in month 9, apparently. So when I drag it to month 9, my balance on the Chase went to 0. I have a new policy loan now that's represented right here. And we take the minimum payment.
For that $2,700 or whatever it was.
Yeah, exactly.
Gotcha.
There it is. We take the minimum payment that was going towards the Chase. We now pay it towards the policy loan.
Would that be called like a debt snowball kind of concept?
Yeah, something like that. You could call it that. And we are just transferring the debt from one creditor to another. The first piece of love
you're
that
not reducing your payments. You're just transferring where they're going.
Yeah. they're going to always make the same debt load payments. We're just going to structure how it goes differently. Okay. And so in this case, we've got the Chase paid off, the $85 a month of minimum payment now goes to the policy loan. All right. Now I'm just going to march a couple more months. Here we go. Year number, end of that year. Okay. So here we are.
Sound effects.
We are a year and 8 months into the. We're a year and 8 months into the plan. All we've done is made minimum payments and make that same policy loan payment. Right now, look what's happened. That cash value has grown to $7,600. Our policy loan has gone down to $1,800. Remember the bank thing we were talking about? The $7,000 is earning a lot more than that $1,800 is earning or paying.
Correct.
Does that make sense?
So the $7,000 is your total net cash value, and you've got a loan for only how much?
$1,800.
$1,800. So you're earning more on the $7,000 than what your loan is for the $1,800 against yourself. You're borrowing it from yourself, and there's a word arbitrage somewhere in there.
That's right.
Right? Where you're actually making the difference.
That's exactly right.
And so now you become your own bank, essentially.
That's exactly right.
What the heck? You can use life insurance to become your own bank? Is that what you're telling me, John?
Pretty much.
Wow. So let's accelerate through this.
So you keep paying these debts off.
What does this look like? How does it end up?
Now watch this.
What's the net result?
I'm going to drag the slider to year 13, month 6, which is when we quoted them they'd be out of debt with our debt action plan. And sure enough, look, they're all out of debt. Okay?
So the side-by-side now has everything is lit up in green on the debt action plan, and the current debt is still a slow boil on at least two of those consumer loans.
Now here's an important distinction. They still have a bill for $85,000 coming in from the insurance company. And they're thinking, well, hang on a minute. Man, you just said we're out of debt.
They have a bill? What?
That's right.
Help me understand that.
Okay. That's the policy loan.
They have a loan for $85,000.
Let me go back
on your own life insurance.
Let me go back 1 month.
Okay.
Right now we have no loans.
Okay.
We have money we put into a savings account.
Correct.
We didn't really talk about, but as you pay all the debts off, we keep that money going into something. We have $92,000 in cash value. We have $286 total. Our balance on our home is $280. I'm going to actually take the money out of the savings account plus a loan against the cash value to pay the home off.
Now, when you say savings account, where's that savings account live?
Well, listen, we say savings account in our system because we want just a really clean compounded rate, but you're going to say something more like a index universal life policy or another whole life policy.
So the savings account is not at a bank.
It's not at a bank.
It's at your bank.
It's going to be your second branch of your bank.
Inside of your own policy.
Correct. Your second policy.
I was just clearing that up. Because when you said we got it in a savings account, I wanted to make a distinction.
It says it there just to make it easy.
But I want to make a distinction for people listening and watching, that it's not sitting in a bank, it's sitting in your bank inside your loan.
That's
so it's
correct.
Parked, and once you achieve that cash value, you're borrowing against that and paying off the mortgage, which eliminates your house debt completely.
That's right. And you're taking your house payment, adding it to all the minimums of all the other payments together to pay that down. Now look, if your strategy was just to pay your debt off and to pay your home off, you are out of debt. Because you can call the insurance company up right now and they'll say, you've got $93,000 of cash value. We'll close your policy off. We have to pay off your $85,000 of loans. And here's a check for $9,600. And
That'd be crazy for you to do that.
It would.
Because you're earning interest on the full.
That's exactly right.
How much in this case?
On the $93,000 right there.
93 grand you're earning interest on.
And we like to tell them to not do that. If their goal was to just get out of debt, they can leave and they're good. And they're out of debt in year 13. Month 6. Okay. But if they keep putting it in there, watch.
And how much were their monthly total payments in this scenario?
Oh goodness, it's $2,575 for the house, $500 for the auto. We're at $2,500. No, more than that. Gosh, what did I do? The house was 25.
Yeah, you're at just a rough number.
35.
Is what I'm looking for.
I'm going to say $3,800 roughly.
So you got an extra $3,800 a month coming in if you decided you were done now and you just closed everything out.
Correct.
So you're debt free and you got an extra $3,800 a month.
That's right. Now, if you keep making those payments, now what I like to tell the agents is that tell your client to pretend like you're still in debt. Just pretend like you're still on the same plan you were on, the 29-year plan.
Yeah.
Make those payments towards your new debt, which is your future, your wealth, Yeah. And so watch this. As I drag it to their 29-year mark of their current plan, that little monthly slider shows up. If I drag it all the way to that, so 29 years, 9 months, their plan finally is paid off. Before they ever met you, this is the path they were on.
Correct.
To pay their debts in 29 years, 9 months, and be out of debt, but they have no money. They're out of debt, but nothing extra. You had them out of debt a long time ago, and if they just continue to make those payments to you and the new strategy you've put together, Roger, look at that number
What
right
do
now.
they have? I can't see it, man. What is it?
$1.1 million.
They have 1.1 million
They have $1.1 million.
in cash value?
Some's in cash value, some is in cash value in the second branch, right,
Okay.
that we opened. But $1.1 million of cash value they can take out and do anything with.
And they own their house free and clear.
And they own their house, they're debt-free.
And all they did was just redirect their money.
And think about that.
And you haven't asked them to make $150
just because
extra
they
premium.
met you. They just met you. You look at their debts. You told them just do this slightly different. No more money than you're already paying. Just tweak it slightly. And $1.1 million looks like it just fell out of the sky for them.
So if I could show you a way to eliminate your debt in half the time or less, and you not have to spend any more money to do it, would you be interested in having a conversation?
That's all it takes.
I could say that to every person I know.
And if you showed them this, that $1.1 million is going to be the result, above and beyond what the path they were already on.
So, John, we're out of
Pretty
time.
compelling.
We're wrapping this one, but you guys have put together something absolutely incredible here, and I know there's going to be a ton of questions about this. To find out more, you need to get on the back end of our Academy platform, courses and coaching. There's going to be more content and information back there on how this works with strategies. There's software, lifeinsuranceacademy.org/agency rocket. Now, we have a special for them to take advantage. This software, you've put your heart, soul, and life into this. You go around the country telling the story to beat this silent epidemic. You don't do this for free. This is your business. It's your life's passion. It's your mission. You've traveled a lot. You're a dad of 5 kids. You love them. You like to be home more.
True.
You live in Tampa. Your partner lives on the West Coast. You meet in the middle. You're like on a crusade trying to solve this silent epidemic. People have to pay for this.
They do.
But through the Life Insurance Academy and the collaboration, we're bringing them a discount. How does that work?
You get a discount. Just go to the address you told them to.
Yep.
Click on the sign up here, and it all takes care of itself. The discount will be applied. You'll see that the discount is applied as you go to checkout.
So the regular retail price, if you go to their website, you're going to pay more.
You're going to pay more.
But if you go through the Life Insurance Academy portal,
That's right.
okay. If you go to the Life Insurance Academy portal, you're going to get a discount and you're going to get special training and you can plug in us because we're going to be offering additional trainings and webinars through the Life Insurance Academy. And yeah, this is an agent. So this is your cost as an agent to tap in, use this software to help you tell the story. If they wrote one policy a month, just one,
Well, yeah.
how much would this cost them? How much would this software cost them if they just help one family a month?
About 150. Oh, well.
How much would it cost them? See, you know where I'm going.
Okay, I got you.
You know where I'm going.
I got you.
They're making money.
They're making money.
If they help one family a month, they're making bank.
That's right.
And they've helped families eliminate their debt in less half the time by not even increasing their payments whatsoever.
That's right.
Guys, this is revolutionary. I'm excited. So there's videos, guys. Go on there. Take a look at the videos. There's demo videos. There's prospecting videos. The analyzer, the reach. It's put together so beautifully. Once I met you guys, I was like, we got to work with you. This is I'm all about making an impact on people's lives. I believe this makes an impact on our country in this silent epidemic, the financial crisis we're in. But I really believe it helps agents have a tool in their arsenal that most people are not even aware of. And you guys have made it simple and easy for them to access and use and deliver.
Thank you.
I don't know how we can say it any better.
I appreciate that.
How can they reach out directly to you?
agencyrocket.com. They can go to support@agencyrocket.com, send an email if they'd like.
Mm-hmm.
But go to our website, agencyrocket.com, and there's ways you can
And
find
social?
help.
How do they find you? How do they DM you? How do they get a hold of you?
Go to that website. You'll see all the links. We got Instagram and Facebook and all those places.
Perfect. Man, pleasure, man. Thank you for being here. Appreciate
Thank you,
it.
Roger. Appreciate you so much.
Hit up that website, guys, lifeinsuranceacademy.org/agency rocket. Hit us up, drop some comments below. You can DM us here all the time. Of course, if you have any further questions. Hopefully this was helpful to you. If you're on the audio version, please go subscribe to YouTube. You'll get all of the video, screen share, and content. We love educating people and love educating clients on how to win at a high level. And today was one of those days. Thank you for watching this episode, and we'll see you on the next one of the Life Insurance Academy podcast.